NVIDIA shares fell more than 5% in a single day, the steepest drop since February of this year. The headlines pinned it on concern over a wave of enormous AI deals. But the way I read it, there isn't just one reason behind this decline. And I'd argue the real story here is a structural shift. NVIDIA is widening its role from a seller of chips into something much closer to a financial backer of AI demand itself. Today, I'll walk you through what that actually means. Welcome to Semiconductor News Decoded. I'm Ty, with 31 years inside the semiconductor industry, bringing you the real view from the factory floor. In this video, I'll break down what is actually inside the giant AI deals that triggered the NVIDIA sell-off, and I'll sort out the real reasons behind the drop, the ones the headlines tend to lump together into a single story. By the end, you'll have a clear framework for how to read this correction.
Here's today's news in one picture. Imagine a wholesaler in town that supplies ingredients to restaurants. We'll lean on this wholesaler all the way through the opening section, so keep it in mind. The quality of what this wholesaler carries is simply outstanding. People say that if you don't buy from them, you can't build a restaurant that succeeds. Orders pour in, and the business has been growing at a breathtaking pace. Lately, though, this wholesaler has stopped limiting itself to selling ingredients. When a favored restaurant wants to open a new location, the wholesaler puts up the money. It co-signs their bank loans. It locks in supply contracts stretching years into the future. In short, it has started financially propping up its customers' businesses themselves. The logic is clear enough. If more restaurants keep opening, the wholesaler's ingredients keep selling. It is, in effect, manufacturing its own future orders with its own money. But there's a trap buried in here. If a restaurant it co-signed for starts to struggle, that debt lands right back on the wholesaler. In exchange for future orders, it ends up carrying its customers' business risk as well. People around town started to murmur. That wholesaler is taking on far too much, surely. Add up everything it has promised, and the total looks staggering. But look more closely, and you find that the pile mixes very different things together. Some investments are locked in, some guarantees are still under discussion, and some are visions for the distant future. All of it was simply added into one number. So the thing that matters isn't shouting that the wholesaler is in danger. It's separating what is confirmed from what is still a concept, and working out how much risk the wholesaler is genuinely carrying. From here, let me walk you through what this actually looks like in the real semiconductor industry. That wholesaler is NVIDIA. NVIDIA shares fell more than 5% on the US market on July 27, 2026, the steepest single-day drop since February of this year. Up to now, NVIDIA's large deals have been read as good news, as evidence of just how strong demand for AI chips really is. This time, though, the market's attention shifted to a different question. How much of the funding burden and the risk is NVIDIA itself taking on? Line up the deals reported over the weekend, and you get this. A long-term AI infrastructure partnership concept with the SK Group, worth more than $500 billion US. Reported negotiations over roughly $250 billion in financing guarantees for OpenAI's data center plans, and a $1 billion equity investment in Naver, the South Korean internet giant. Added together, the reported figure comes to more than $750 billion US. That $750 billion figure needs a warning label, though. NVIDIA is not about to write a check for that amount. It's a sum of very different kinds of money. Confirmed investments, long-term capital spending concepts, and financing guarantees still at the negotiation stage. The SK Group piece in particular, the one above $500 billion, is the scale of the entire plan, including the Korean side, not NVIDIA on its own. It's important not to panic at the sheer size of a number. On the same day, something else was happening in Europe. ASML, the Dutch lithography equipment maker, fell about 9%, and the selling spread to other European equipment makers as well. Behind it was a report that a Chinese state-linked company had begun manufacturing immersion DUV lithography systems. Whether that report holds up is still to be verified,
but the market reacted to the prospect of this equipment being localized inside China. Now, here's the heart of it. The coverage says the drop was caused by concern over these enormous investments. I find it hard to accept that as the whole explanation. The SOX index roughly doubled in the first half of 2026 alone, then fell about 20% from its late June high, and the correction continued right through July. July 27th was simply one day inside that correction. So the question isn't only why it fell. You also have to ask why it climbed so far in the first place. In fact, if you look back across July, the reason given for each decline changed almost every week. One week it was Meta bringing AI chip design in-house. The next it was Intel. The week after that, TSMC's capital spending. And this time, the China DUV report and NVIDIA's massive investments happened to land on the very same day. Every time the stock moves, a single reason gets attached to it. But real markets move on several things at once: profit-taking, interest rates, investor psychology. Does that mean NVIDIA's moves are meaningless? Not at all. What I'm watching is a structural shift. NVIDIA is moving from a company that sells GPUs and collects payment into a company that props up AI demand itself through equity stakes in customers, financing support, long-term supply agreements, and direct involvement in building data centers. This, I'd argue, is the deepest issue in the whole story. That shift is a double-edged sword. On one side, NVIDIA gets to secure its own future GPU demand. On the other, it may indirectly shoulder its customers' risks, their business plans, their power procurement, their data center utilization rates, and whether the money actually comes back. What the market has started asking about is exactly that line. How far in is NVIDIA willing to go? That, I believe, is the real question.
There's another way to read this, and that's a correction in valuation itself. With AI-related stocks, expectations for the future have been priced in well beyond the actual growth in earnings. This week, with a Federal Reserve meeting ahead, it was a natural moment for profit-taking in high PER names. You can see it as expectations getting tidied up a little. Even looking at this decline, I don't think AI investment itself is about to stop. Around the world, enormous spending on AI data centers is still underway, and not just GPUs. HBM, CPUs, networking, optical communications, servers, cooling equipment, construction, power infrastructure. The investment spreads across a great many industries, and semiconductors remain one of the starting points that drive global capital spending. Let me turn to what this means for Japan. The wider the base of AI infrastructure investment grows, the more that spending ripples out into materials, production equipment, power infrastructure, and construction, areas where Japanese companies hold real strengths. Separate the stock correction from the real demand, and watch which industries the actual investment flows into. That, I think, is the shortest path to spotting Japan's opportunity. One last thing. I work in the semiconductor industry myself. My salary, my bonus, my employment, my retirement package, even the value of my own experience, all of it is already tightly bound to the semiconductor cycle. If I then concentrated my financial assets in semiconductor stocks as well, I'd be putting my human capital and my savings into the very same basket. Believing in the future of semiconductors and concentrating your investments in semiconductor stocks are two different things. That's how I think about it. Let me sum up. The drop of more than 5% in NVIDIA shares wasn't caused by the giant AI deals alone. It's more natural to read it as several factors landing together: the correction that was already underway, the China DUV report, and a tidying up of very high valuations. What matters isn't one day of price movement. It's whether AI investment ends up connecting to real earnings growth from here. Let's keep watching that with a cool head. That's all for today. I'll keep bringing you semiconductor news and analysis. So if you found this useful, please like, subscribe, and I'll see you in the next video. This has been Ty on Semiconductor News Decoded.